Welcome to WealthWing Financial, where we help you build real wealth in the real world. I'm your host, and today we're diving into a topic that might ruffle some feathers around the Thanksgiving table. Here's a question for you. When was the last time your parents told you that you're throwing money away on rent, or that you need to get on the property ladder before it's too late? If you're like most millennials or Gen Z listeners, probably last week. But here's the truth bomb. Following your parents' real estate advice in 2025 could be the worst financial decision you'll ever make, and I've got the data to prove it. Today, we're going to shatter some deeply held beliefs about homeownership and wealth building. We'll expose why the rules that worked for baby boomers are now a fast track to financial disaster. More importantly, I'll show you exactly how modern wealth builders are getting rich without ever signing a mortgage. But first, let me be crystal clear. This isn't about bashing homeownership or telling you to never buy a house. This is about understanding that the game has fundamentally changed. And if you're playing by 1985 rules in 2025, you're going to lose.
The shocking state of real estate in 2025. Let's start with some numbers that'll make your head spin. The median home price in America right now, we're talking $403,700 to $414,000, depending on which data you look at. That's an all-time high for this time of year. But here's where it gets really interesting. The price-to-income ratio, basically how many years of your salary it takes to buy a house, has hit 5.6 nationally. Your parents? They bought homes when that ratio was 3.5. In some markets, like San Francisco, we're looking at ratios over 12. That means if you make $100,000 a year in San Francisco, the median home costs $1.2 million. Let that sink in. Now, you might be thinking, well, interest rates will come down, right? Wrong. We're sitting at mortgage rates around 6.86% for a 30-year fixed, and every major bank, from Wells Fargo to Fannie Mae, is projecting rates to stay above 6% through at least 2026. The days of 3% mortgages, they're gone, and they're not coming back. Here's the kicker. 82% of current mortgages have rates below 6%. A quarter of them are below 3%. These homeowners are locked in. They literally can't afford to sell and buy something else. It's called the lock-in effect, and it's strangling inventory. But wait, there's more bad news. First-time buyers now make up only 24% of the market. The historical average? 38%. Why? Because you're not just competing against other families looking for a home. You're up against institutional investors with cash. In 2024, 26% of all home purchases were all-cash deals. As one real estate expert put it, first-time buyers essentially have zero chance against cash buyers. Let me paint a picture of what this means in real terms. To afford the median-priced home today, you need a household income of $147,433. Only 31.5 million households out of 130 million in America qualify. Every quarter-point increase in interest rates prices out another million households. And here's the real gut punch. Housing costs have increased 197% since 2000, while median income has only risen 40%. If home prices had just kept pace with inflation, that median home would cost $177,788 instead of over $400,000. This isn't a temporary blip. This is the new normal. And if you're waiting for things to go back to normal, you're going to be waiting a very long time.
When your parents bought versus now, the generational divide. Now, let's talk about why your parents' advice made sense for them. When the average baby boomer turned 30 in 1985, the median home price was $82,800, and the median household income was $23,620. That's a price-to-income ratio of 3.5. Challenging? Sure. Impossible? Not even close. Today, when the average millennial hits 30, They're facing a median home price of $313,000 with a median income of $68,700. That's a ratio of 4.6, and in many metros, it's over 8. But that's just the beginning of the story. Your parents didn't have student loans crushing their ability to save. The data is staggering. 60% of millennials say student debt delayed their home buying. The average millennial with student loans owes $126,993. Every $1,000 in student debt delays homeownership by 4 months. Do the math on that. But here's what really gets me: the age of first-time buyers. In 1981, it was 29. Today, it's 35 to 38 years old, the oldest since we started tracking this data. Your parents bought homes in their 20s. You're lucky if you can buy in your late 30s. And let's talk about job security. Baby boomers had pensions. They had 30-year careers at single companies. They had predictable income growth. What do you have? The gig economy. Contract work. No benefits. In 2023, 52% of Gen Z and 44% of millennials did freelance work. Try getting a mortgage with inconsistent 1099 income. Good luck. Here's a stat that should make everyone angry. At age 30, baby boomers had a 52% homeownership rate. Millennials at 30, just 43%. That 9 percentage point gap represents millions of people locked out of the traditional path to wealth building. The most insidious part? When boomers faced high interest rates in the 1980s, and yes, rates hit 18% in 1981, home prices were still proportionally affordable. A high interest rate on an $80,000 house is manageable. A 7% rate on a $400,000 house will destroy you financially. Your parents lived in an era where working hard and saving consistently virtually guaranteed homeownership. They could put 20% down from a few years of savings. Today, the median down payment requirement equals 75% of annual disposable income. For your parents' generation, it was 52%. So when mom and dad tell you that you just need to work harder or stop buying avocado toast, they're speaking from a reality that no longer exists. They're giving you directions to a destination using a map from 1985. Following those directions won't get you where you want to go. It'll get you lost.
The outdated advice that's killing your wealth. Let's demolish some sacred cows. These are the pieces of wisdom your parents swear by that are actually toxic in today's market. Rent is throwing money away. This might be the most dangerous lie in personal finance. Here's the reality. Mortgage payments are averaging 38% higher than rents in most U.S. cities. But that's just the beginning. Homeowners face $18,000 to $24,000 annually in hidden costs beyond their mortgage. Property taxes average $4,316 nationally, but exceed $10,000 in places like New Jersey. Maintenance? That's another $8,808 per year. Insurance, HOA fees, surprise repairs, it never ends. Meanwhile, if you took that down payment, let's say $70,000, and invested it in the S&P 500, historical returns show it would grow to $274,000 over 18 years. That's a $204,000 opportunity cost. The S&P 500 has delivered 10% average annual returns. Housing? 4 to 8% if you're lucky, and that's before all those hidden costs. Buy the biggest house you can afford. This advice has created an epidemic of house-poor Americans. Right now, 27.4% of U.S. homeowners are house-poor, spending so much on housing they can't save for retirement, emergencies, or their kids' education. In Bankrate's latest survey, 42% of homeowners with regrets cited maintenance and hidden costs being higher than expected. The old rule was buy as much house as the bank will let you. The bank will let you destroy your financial future. They don't care if you can't afford groceries as long as you make that mortgage payment. Real estate always goes up. Tell that to anyone who bought in 2006.
The Case-Shiller Index recorded its largest price drop in history in December 2008. Some markets lost 50% of their value. Detroit, Cleveland, and other Rust Belt cities have seen decades of stagnation or decline. Robert Shiller, the Nobel Prize-winning economist, not your uncle on Facebook, found that after adjusting for inflation, housing appreciation averaged just 0.2% annually over the 20th century. 0.2%. Your savings account beats that. Your home is your best investment. This is mathematically false. Stocks have outperformed real estate over virtually every meaningful time period. Real estate is illiquid. It can take months to sell. Transaction costs eat 6 to 10% of your property value. You can sell stocks instantly with a click. Plus, putting all your wealth in one property in one location is the opposite of diversification. It's concentration risk on steroids. One local employer leaves town, one natural disaster, one zoning change, and your net worth evaporates. Get on the property ladder at any cost. This mentality has people taking on crushing debt, emptying retirement accounts, and begging family for down payment gifts. The data shows 78% of homeowners dealt with unexpected repairs in 2023, but only 24% had money set aside for them. The other 76%? They went into debt. The forced savings argument for mortgages is bogus too. Most of your early payments go to interest, not principal. You build almost no equity in the first 5 to 7 years. That money locked in home equity, it's earning nothing, and you can't access it without selling or taking on more debt. Here's the truth your parents won't tell you. These rules worked in an era of affordable housing, stable jobs, and reasonable price-to-income ratios. That era is dead. Following this advice today isn't just outdated, it's financial suicide.
Modern wealth-building strategies that actually work. Enough doom and gloom. Let's talk about solutions. How are smart young people building serious wealth without touching real estate? The answers might surprise you. Strategy number 1, index fund investing with extreme prejudice. Forget trying to pick stocks. Low-cost index funds are your wealth-building weapon. The Vanguard Total Stock Market Index has an expense ratio of 0.04%. That's $4 per year for every $10,000 invested. Compare that to the thousands in annual costs for home ownership. Here's a real example. The Millennial Revolution couple started investing in index funds in 2012 instead of buying a house. By 2015, they had $1 million portfolio. 3 years. They used the 4% withdrawal rule and retired in their 30s. Start with as little as $100. Automate $250 monthly contributions. With historical returns of 10 to 12% annually, that monthly $250 becomes $500,000 in 30 years. No maintenance, no property taxes, no 3 a.m. calls about broken water heaters. Strategy number 2, geographic arbitrage. This is the secret weapon of the remote work era. A software engineer making $120,000 in San Francisco needs just $61,000 to maintain the same lifestyle in Tulsa. That's $59,000 in annual savings. Invested properly, that's early retirement in a decade. Here's how people are doing it. Keep your high-cost area salary, move to a low-cost location. Some are taking it international. That $80,000 U.S. salary goes incredibly far in Portugal, Mexico, or Thailand. One couple lived in Mexico for $400 a month while banking San Francisco consulting rates. Strategy number 3, house hacking without the traditional mortgage. If you must get into real estate, be smart about it. Buy a duplex with an FHA loan at 3.5% down. Live in one unit, rent the other. Your tenant pays your mortgage. But here's the modern twist. Combine it with Airbnb. One couple rents their spare rooms on Airbnb when traveling, earning an extra $18,000 annually. Or skip buying altogether. Rent a larger place and sublease rooms. You get the benefits of shared housing costs without the anchor of a mortgage. Strategy number 4,
the multiple income stream machine. Rachel Jimenez built 7 income streams generating $14,000 monthly passive income. How? Digital products on Etsy, online courses, affiliate marketing, dividend stocks, REITs, and 2 rental properties, bought after she'd already built wealth, not as a way to build it. The key is starting small. Create 1 digital product, build 1 income stream, then another. Chris Herron created 1 online course that generated 7 figures in passive income. 1 course. Strategy number 5, REITs, real estate without the headaches. Want real estate exposure without the crushing debt? REITs are delivering 3.8% dividend yields versus 1.3% for the broad market. Some, like Realty Income, pay 5.69% dividends monthly. Monthly! You can start with $100, you get instant diversification across hundreds of properties, professional management, daily liquidity, and here's the kicker. REITs have historically matched or beaten direct real estate investing returns without any of the hassle. Strategy number 6, the new FIRE movements. Forget traditional retirement at 65. Coast FIRE is where you save aggressively until 30, then let compound interest do the work. Save $100,000 by 30, and it becomes $1.6 million by 65 with 0 additional contributions. Or try Barista FIRE. Save enough to work part-time doing something you love while your investments cover the rest. No more soul-crushing corporate jobs just to pay an oversized mortgage. Real success stories. Michael and Ellen Robinson achieved financial independence at 33 through geographic arbitrage. A college student bought a 4-bedroom house, rented 3 rooms, lived for free while building equity. Software developers banking $200,000 salaries while living in $500 a month apartments in Eastern Europe. Side hustlers scaling Etsy stores into 6-figure businesses while keeping day jobs. The common thread, none of them followed traditional real estate advice. They built wealth through diversification, low costs, and smart leverage of modern tools and opportunities.
Current market reality check. Let me hit you with some final reality checks that should drive this home. Right now, 83% of institutional investors plan to increase digital asset allocations. Bitcoin crossed $100,000. Coinbase joined the S&P 500. The smart money isn't piling into residential real estate, they're diversifying into emerging assets. Housing inventory? We're at a 4-month supply. A balanced market needs 5-6 months. New construction is only growing 3% annually. The lock-in effect has 1.72 million potential sales frozen. This isn't getting better anytime soon. Price projections for 2025? NAR says 2 to 3% growth. Zillow turned bearish, projecting actual price declines of up to 1.7%. When the real estate industry's biggest cheerleaders are predicting stagnation, you know things are bad. Meanwhile, companies are adding 401k matches for student loan payments. HSAs are becoming triple tax-advantaged investment vehicles. Robo-advisors are managing money for free up to $25,000. The tools for building wealth outside real estate have never been better or cheaper. Here's what really gets me. In major metros, institutional investors are projected to control 40% of single-family rentals by 2030. You're not just competing against other families for homes. You're competing against Wall Street, and Wall Street has deeper pockets than you.
Your action plan, building wealth in the new economy. So what do you actually do with this information? Here's your blueprint. Month 1 to 6, foundation. Build a 3 to 6 month emergency fund. Yes, even before investing. Open a robo-advisor account with $100. Maximize your 401k match. It's free money. Start tracking every expense to find savings opportunities. Month 6 to 18, acceleration. Increase your savings rate to 20 to 30% of gross income. Add REIT exposure for real estate diversification. Launch one side hustle, just one, but do it well.
Investigate geographic arbitrage options if you're remote eligible. Month 18 plus, optimization. Consider house hacking only if the numbers truly work. Add 5 to 10% alternative asset allocation. Scale successful income streams. Work toward coast fire benchmarks. The non-negotiables. Automate everything: investing, saving, bill paying. Focus on reducing expenses as much as increasing income. Never invest money you'll need within 5 years. Diversify across asset classes, not just stocks. Remember, every dollar you don't sink into an overpriced house is a dollar that can compound at 10 to 12% annually in the market. Every month you stay flexible is a month you can pursue better opportunities.
Conclusion: the new rules of wealth. Here's the bottom line. Your parents' real estate advice made sense in their era, an era of affordable housing, stable jobs, and reasonable valuations. That era is gone, and it's not coming back. The new rules are different. Flexibility beats stability. Diversification beats concentration. Low costs beat high leverage. Multiple income streams beat single paychecks. Geographic arbitrage beats location lock-in. You don't need to own a house to build wealth. In fact, in 2025, not owning a house might be your competitive advantage. While your friends are house poor, stressed about repairs, and locked into locations by underwater mortgages, you'll be building diversified wealth, traveling the world, and actually enjoying your money. The math is clear. The trends are undeniable. The smart money has already adjusted. The question is, will you keep following advice from 1985, or will you build wealth for 2025 and beyond? This podcast is for educational purposes only and should not be considered personalized financial advice. Everyone's situation is different. Consider consulting with a qualified financial advisor before making major financial decisions. Thank you for joining us at WealthWing Financial. If this episode opened your eyes, share it with someone who needs to hear it, someone whose parents are still preaching the gospel of home ownership at any cost. Remember, building wealth isn't about following your parents' playbook. It's about writing your own. Until next time, keep building that wealth the smart way.